Welcome to the Wealthy Life Podcast. I'm Sybil Verch, and with us today is a nationally recognized voice in personal finance. He wrote for the Globe and Mail for nearly 3 decades. He is known for his no-nonsense, straight-talk style and occasionally some controversial opinions. He helps Canadians stay informed to make smart decisions, and he's going to share with us today his top tips for building wealth. Mr. Rob Carrick. Rob, welcome to the show.
Thanks for having me, Sybil.
So since retiring from the Globe and Mail, what have you been up to?
Well, I've been doing a lot of personal finance things. I've been doing some speaking engagements. I just came back from Canadian Forces Base Gagetown in New Brunswick, talking to people at the artillery school there. I've been doing some consulting for people and organizations in the financial area. And I've started a Substack newsletter about personal finance. I found Substack, there's so many great voices out there, but not that much on personal finance. So I'm breaking in. And I'm also writing twice a month for the Globe and Mail.
And that's what you call retirement?
Well, is a retirement. Retirement's just a word that says I don't work full-time at my former employer anymore. Now I do other things. What I like to say is I've gone independent.
I love it. I always thought retirement was a dirty word. If you do what you love, it's not really working, and it sounds like you're doing what you love.
Yeah, exactly. I am.
Well, there's many Canadians who'll be happy to hear that you're still at it, because your voice would be missed otherwise.
Thank you.
So let's kick it off with a good question that I like to ask my guests, which is, what does the wealthy life or living the wealthy life mean to you?
It means freedom from worrying whether I can afford to do what I want to do. I have put plans in place and done the savings or put the investments into place where I can map out what I want to do with my life and find the funds to do it and not worry at every turn that I'm somehow off track. So that's a multi-year process. A lot of years are spent moving towards that goal. But as I transition from full-time work to working part-time, I'm really starting to feel the benefits of all the work I've done. And I think that's how I would define what you're talking about there.
I know it's a good reminder for people. It's not very exciting to think about retirement when you're 20 years old, but those people that start early can really be enjoying life and have no stress later if you plan ahead.
I would say early and consistent. You don't have to knock it out of the park on retirement savings at 25, 26, 27, and so on. You just need to be paying attention to the fact that you should be doing something and trying to do something on a consistent basis. If you miss 1 year, double down the next year. Not forgetting about the long term and how much you are going to love all the work you did in your 20s, 30s, and 40s when you retire. All those compounded savings are going to be such a great thing when you leave the workforce. They're going to do so much for you. So
for the younger generation, what do you recommend they do? Like, how do they take advantage of that compounding growth? Where do they need to start?
Well, what I would start is, unfortunately, home prices are so expensive that a lot of young people are going to decide, I want to own a home. That's such a top financial priority for me. I think they're going to have to get into the housing market. And that's probably going to require most of their financial resources and savings capability. If not, I would love to see them start putting even a token amount of money away. If they work at employers with company pension plans, they've got to get in those as soon as possible, because that money is taken off the top. Your pension contributions, you don't even see them. You don't realize they're happening. They're just taken off the top, and you're going to get matching money for your employer. A fantastic way to get started saving for retirement, and it's virtually painless because you never even know what's happening. And if you're into the housing market and you've got your hands full with home ownership, you've got to plot a way to start creating some money for retirement savings. Maybe your raise, your bonus, your promotion, your new job, somehow that's freeing up extra money. Don't just spend it on your lifestyle. Use some of it to begin the decades-long process of saving for retirement.
Is there a magic number that you see working best for people, a percentage of or a dollar amount?
You know what, I'm going to stay away from those, because I find when I tell people a certain percentage and they think, oh, that's not even close for me, they tune out. And so what we're doing when we give percentages, we're saying to a lot of people, this is how they hear it anyway, if you're not saving 10%, you're a fail. Right. And I don't want people to come away with that. So I would say, as you start off saving for retirement, anything is better than zero.
Oh, that's great advice. We don't want people to feel like a failure. And if they get started on a plan, then life circumstances get in the way and causes them to put that plan on hold. That can feel terrible as well. What do you tell people who get off track?
No problem. I would say no problem. There's plenty of time to get back on track. Everybody whiffs once in a while in personal finance and investing, and anyone who says they haven't is lying to you. You know what? Life is hard and there are going to be setbacks. What you've got to do is figure out my path back to where I want to be. How do I knock down the debt that I've accumulated? How do I return to savings? How do I build up my emergency fund? That sort of thing. Life is long and all mistakes can be fixed.
Yeah, I think that's good advice, and that advice applies to more than just finance. If you think about you're trying to get into a fitness routine, and January 1st, everyone hits the gym hard, and then usually by around the 9th of January, all of a sudden it slows down, and people just give up, and maybe they don't try again until the next year, but they do try again.
You know, I think it's important to create goals in fitness and investing and personal finance that are doable. Like if you say, I'm going to work out 5 times a week, that may be too much. How about you do 2 or 3 times? Saving, if you can't do 10%, try 5, try 2.5, try 1 if that's all you can do. Yeah. The thing is to have some forward momentum.
So if people start paying themselves first, they need to put money aside at the younger generation, to maybe buy a house, which is probably a priority for most young folks today, and also not easy to do because housing prices are a little higher than maybe we'd like to see. Put a little bit away. What do they do with the money? How should they invest it?
Well, I really like first home savings accounts, FHSAs. They're still relatively new, and I don't think they're very well understood quite yet, which is normal because it takes years for these things to become, clear and understandable and friendly to people. But the FHSA is a great vehicle for saving for a home down payment. And if you never buy a home, fine. The money can be put into your registered retirement savings plan. So you've done yourself a favor on retirement savings. Failing that, I think young people in particular, the TFSA, the tax-free savings account, is just such a great vehicle. RRSPs are very good as well, but there's issues with them because you do pay tax on the withdrawal, which is only fair because you got a tax deduction on the contribution, but people kind of don't connect those two, and they get into retirement and they're paying tax on their RRSP withdrawals, and they get angry about that, even though they really shouldn't. With tax-free savings accounts, the money goes in, it accumulates tax-free, and it can come out tax-free, and people love that. Believe me, it's got the best word of mouth of any financial product or account I've ever come across.
I know, and those numbers are building over the years. When it first came out and people could put $5,000 in, people thought, big deal. You save tax on the growth on $5,000, but multiply that every year and the amounts go up, and people now have, if they've invested well, there's people with several $100,000 in this tax-free savings account.
Absolutely, and they can help themselves to some of that money at any time, tax-free, and they can put it back later if they want. It's such a versatile tool.
I know, it's great. I hope they don't change the rules on that. So if young folks want to buy a house today and it's just feeling unaffordable, what advice do you have for them?
Well, one thing I'd like to interject here is a subject I'm sure you're very familiar with, Sybil, which is the intergenerational wealth transfer. And there's a lot of parents who are willing and in some cases even eager to help their kids buy a house. So that may be the difference maker in some fortunate families. Barring that, I don't see any problem with renting. I don't think renting is a second best consolation prize. If you can't afford a home, the realistic alternative is to be a renter. You're going to say rents are not cheap, but they are still much less expensive than owning a home. You don't pay property taxes and you don't pay upkeep and maintenance when you're a renter. And that's huge amounts of money. Any homeowner who's honest will tell you. So what you're doing is you're renting and you're saying, I'm saving a lot over a homeowner. How much of that can I invest? And you fill up your TFSA and you fill up your RRSP, and if necessary, you go to a non-registered account and you build up wealth that isn't real estate. It's liquid security stocks, bonds, funds, GICs, whatever you like. And that is your wealth rather than home equity. And you can't sell it tax-free like you can a principal residence, but it's a lot more accessible, it's a lot more liquid, and in some ways a lot more useful than home equity. So I think the renter can be financially successful. Most people will be happiest if they own a home, and I recognize that. And I think a home offers great stability and all kinds of great things. But if you're a renter by necessity or choice, you can be financially successful.
Yeah, I think that you bring up a good point. The key is being disciplined enough to save the difference. So if you can
So
rent a
important.
place for $1,500 a month, whereas owning the same place cost $4,000 a month, if you can afford it, put the $2,500 difference into investments. And in some cases, you may even 30 years later or 25 years later have more by renting than you would by owning. But I think for the majority of Canadians, owning a home is like a forced savings plan. You need somewhere to live anyways, and you've got your money going into hopefully an appreciating asset. But look what's happening right now in the real estate market. Things aren't going up today. What do you have to say about that, Rob?
Well, in a way, it's almost refreshing because like housing went up too much for too long and it distorted people's view about what the benefits of home ownership are. And I thought a lot of people are making financial decisions that are not really in their best interest, but they're thinking, this home is stretching to the very limits of affordability, but I will buy it because I know that it will start appreciating in value right away. In like 3 hours from now, the price will be up like $1,000 in a year. It'll be up 10% or whatever. And people thought it was just a can't miss financial situation. And they got themselves into these very expensive homes with high mortgage payments. And now home prices are not appreciating. They're going down in expensive cities like Toronto and Vancouver. They're doing okay in other cities, but the most expensive cities are seeing declines. And it's just a reminder that housing isn't a rocket ride to great riches. It can be up and down. I think a lot of housing markets really appreciate by the inflation rate more or less every year. And we're starting to see a return to that in some cities. And in the more expensive cities, prices are going down, and they could continue to go down further, especially if there's political or economic uncertainty in the world. And when isn't there those things? So prices could go down a little bit more. I'm not predicting any great cataclysms or anything like that, but I think we have to be realistic that home ownership is primarily about the lifestyle and about the raising a family and having your own space. And then secondarily, it is a long-term appreciating asset, but it is not the best asset like it used to be thought of.
Yeah, I think that is a very good reminder for people today. Over the last 3 decades that I've been in finance, now we're aging ourselves, Rob, but I've seen so many people say, the real estate is the sure thing and I can earn more money in real estate. And really long-term averages, real estate should only appreciate by about inflation. And basic economics, supply and demand, kind of bring that into an equalized position over time. We've just had a long period here where that hasn't been the case in a lot of the major cities. And so it gave people a false sense of hope or false expectations of what they could make. And they're learning the hard way.
They're learning the hard way. And isn't it interesting that while this was happening, while real estate was cooling and moving back more to a rational, realistic path, the stock markets were giving us double-digit gains in 4 of the past 5 years. So, I mean, is housing versus financial markets? It's not even close at this juncture.
No, it's not. Now, the good news is a truly diversified wealth portfolio would have both. You'd own your own home and you'd be building up a really good investment portfolio. So what does a good investment portfolio look like for you, Rob?
Diversification is the key, and low cost, and not taking big bets on particular sectors or particular stocks. I'm a big believer in index investing because it exposes you to everything that's hot, and it contains your exposure to everything so that if something goes wrong, it doesn't torpedo your whole portfolio. But even without indexing, I'm a big believer in having a chunk of Canadian equities. I mean, a chunk of US and a chunk of international, some bonds, maybe a little cash if you feel like some bargains might be emerging in the next little while. I've heard a lot of trash talking of the Canadian stock market in recent years, but we are punching above our weight right now. 30% gain last year, quite a bit better than the US market. We don't have the tech component, but when commodities are in vogue as they are now, we do very well. And so I would encourage people not to forget about Canada. That's an important piece of the puzzle.
Well, especially if you are Canadian and you're planning on spending your money in Canadian dollars, because when you invest internationally, you've got to also factor in currency exchange, and that can work in your favor or it could work against you.
Absolutely. Currency can quietly take your gains, some of your gains away. And you're right. Living in Canada, Canada should be a big front and center piece of your portfolio.
So you talked a little bit about fees and low cost. I know you've written several times on this over the years, and this is one of those controversial opinions I was talking about earlier. Obviously, low cost is great. Everyone wants the cheapest, but is the cheapest always the best? And have your views shifted at all from where they were, say, 20 years ago to where they are today?
They have shifted, but one thing we have to remember about 20 years ago was it was really a mutual fund world.
Yes.
Like investing for most people involves mutual funds, and mutual funds back then were quite expensive. And so the constant harping for me and many others about you need to cut costs, you're paying too much, you're losing too much to fees. The fees were astronomical then. Today I am. Today I've realized that I've created, and other people writing about fees have created, these people who are sort of overly focused on hammering fees down to the lowest thing possible. We've actually trained people to be too fee conscious and not value conscious enough. I am a big believer in cutting fees to the bone, but you have to think, what value am I getting? So if we say that a portfolio of ETFs that you run yourself is the cheapest, best value out there, I say, well, what if you don't really know what you're doing? What if you need financial planning help? What if your portfolio isn't that diversified enough? What if you're taking a lot of risk? Paying an advisor can be a very good value. Yes, you are incurring fees, but it is giving you quantifiable benefits that are helping you make more money, even though you're paying more fees. So I think the value part of the equation is key. When people say, I've cut my fees to the bone, I'm thinking, okay, but let's see what you're getting. And if you paid more, might you get more in some ways?
Yeah, I think that's a really good point. I've always been a big believer in looking at the value. Of course, we want a good deal. Everyone wants a good deal, and you want to keep fees down, but are you getting the value for the fees that you're paying? And that's not always around rate of return. Because we know if you look at mutual funds, I don't know what the current stats are, but I'm going to guess around 20%, maybe 30% on the high end of mutual funds outperform the index. And a lot of that is because the fees are higher within a mutual fund than they are in an ETF. So if you're just looking for money management, period, then the fees play, a pretty big role. But if you're looking for some of the other value of advice, like the staying disciplined, the behavioral coaching, the advisor that holds your hand when the markets are down and prevents you from selling and taking a 20% loss, is worth 20% in that particular year.
So true. And another service that advisors and planners provide that is so important is, am I on track?
Yes.
Like the planner, the advisor finds out what the client's goals are, what their aspirations are, sees where the client is, recommends a course of action, and then you can go along and say, you're on track. Everything you said you wanted to happen, we see based on everything that where you are now, it's going to happen. Oh, there's been a setback. We need to change course a little bit. It's that feeling of, am I okay? That is where the real value is to me. And I'm speaking as someone who who wrote a lot about investing and did a lot of DIY investing, but towards later in my career, I did get a financial planner who's now managing our portfolio. And I can tell you that the am I okay answers to my questions are huge.
Okay, so you see the value in hiring an advisor yourself.
I do. I don't. I didn't need one at a certain point in my life, and then I decided, yes, I do.
Yeah.
Also, I wrote about investing, and I was immersed in it, and I thought, I have no time for my own stuff, and I thought someone needs to be paying attention, especially as I get closer to retirement. So I hired someone to do that.
And you know what? The time component can't be understated or undervalued. I mean, the do-it-yourself investor, if you're disciplined enough to buy diversified ETFs, build your own portfolio, set it and forget it, add to it every month, dollar cost average, you might be okay. But that's not usually the case. And even the planner side of it, are you going to be okay? Well, maybe being okay means, gee, you need to save an extra $500 a month for the next 12 years. And having an advisor as that accountability partner can really help hold you to task and make sure you're successful at the end of the day.
Yeah, it's very important, I think, to have a sounding board. A lot of times when you're DIY investing, you're seeking, advice and thoughts online, but you really have no one to sort of bounce ideas off of. And And I think the planner becomes almost your co-pilot, and there's a lot to be said for that. I mean, I'm finding a lot of value in that. I think, you know, in your 20s and 30s, when you're just starting getting into it and setting the patterns, and if you're smart enough to get involved in regular investing or regular saving and that sort of thing, you don't need a planner. But as you acquire more assets and there's more issues, and you have kids and houses, and you've got university educations, and you think maybe I want to help my kids buy a house, and I'm starting to think about retirement. Can I retire at 65? Can I retire at 62? Do I need to work longer? Do I need to contribute more? Having someone who is immersed in all of this and is accredited and professional, very, very big value there.
Yeah, and I'd like to elaborate a little bit more on that, because not all advisors are created equal. And so the types of services that you're talking about are the real value pieces of a relationship and worth the fees that you may pay to an advisor. But how do people know they've got the right advisor? What are some of the things they should be looking for?
Well, you know what, one of the problems is that there's a lot of terms thrown around, you know, wealth consultants, investment advisor, financial planner. I think what you want to have, I mean, I think the value is more in the planning side of it than the portfolio management side of it. I mean, I could even see you having a fee-for-service financial planner where you pay a planner a flat or hourly fee, and then you go and manage your own portfolio based on the asset allocations that the planner has given you. But I think a lot of people, what they want is all-in-one service. So someone who will manage your portfolio for you based on a financial plan that sort of says, here you are now, here's where you want to go, here's how we're going to get there, and the investments will be in service of that. That to me is the real package.
Yeah, and is there some questions that you would recommend people asking when interviewing advisors?
For sure. I mean, I would ask what financial planning services you provide. I mean, of course, you manage my portfolio. That's great. But what else do you do? Like what services do you provide to help me prepare for retirement, to make sure I have enough savings to cover any sort of emergency? What type of retirement income do you see me on a path to having? How can you help me figure out how much I actually need on a monthly or yearly income basis in retirement? You know, what questions are you asking me, or what do you want to know about me? The planner who doesn't ask a ton of questions about you, I really have questions about how interested they're going to be in your account. I would also ask, what's your accreditation? I really like to see the CFP, the Certified Financial Planner, Registered Financial Planner, maybe a PFP, a Personal Financial Planner. But please have some accreditation. Just don't call yourself an advisor, a planner, a coach, or what have you. You need to have studied financial planning so that you can professionally work for me.
I like the term coach that you said in there. And I know we're seeing a huge migration or innovation in terms of compensation platforms when it comes to financial advice. So you've got the do-it-yourself platform, you've got robo-advice, and then you've got the full-service advisor. It used to be commission-based, now it's more fee-based traditionally. But there's this missing middle that seems to be unsolved yet. But where people, if they are going to do it themselves, A, do they have the time to put into it? Do they know what they're doing? Are they disciplined enough? Assuming they are, who do they go to for help? And is there an a la carte fee structure starting to emerge? Does that have any legs to it?
It's emerged, and it has more legs than I would have ever imagined it would. I mean, I was talking to financial planners who had waiting lists, long waiting lists, like months and months. These planners, basically what they do is they say, for a full retirement plan, it costs $3,000. But if we're going to do like more advanced, like if you own real estate investments or you have a business, it'll be $5,000. If you're a young couple who want to come in and talk about the affordability of home ownership, that's $1,000, $500. It's a menu, and you pick what you want, and you can find out how much that will cost you. And it really appeals to people. It opens it up, and it makes people think, I know what I'm getting and I know how much it costs. I feel comfortable because of that. One of the things about sort of investment advice and having an advisor is a lot of people aren't really sure what the advisor does for me. Okay, they manage my investments, but what else? With the financial planner, it's almost like you're engaging the planner to discuss topics A, B, and C. You basically set the agenda, and it's easy to see how much you're paying. And I think I've mentioned that type of financial planning to people at speaking engagements I've done. And I say, if you're interested in this, I have a directory of fee-for-service planners across the country. Email me, and I'll send it to you. And I would get back to the office after, and I would see, oh, I have like half a dozen people who emailed me during the session to get this list. And it made me think people that's resonating with them. They want this.
Well, they
And
like the lack of conflict of interest. So if you hire
I
a
love it.
fee-only planner that is just going to do the financial plan for you, not tied to the sale of any specific investment products, there's some credibility there. But as you said earlier, many people still want the ongoing support, sounding board, accountability partner to keep them sticking to the plan.
Yeah.
Because doing a plan once and forgetting about it is probably not going to be effective. Would you agree?
I would agree, and I've heard that over and over again from people in the planning and advising business. They say, "Yeah, my client has a plan, and it goes into the drawer, and they never ask me about it." And I think the financial advice business is really moving into the financial planning realm a lot more. Like it is commonplace now. It used to be kind of exotic. If I had an investment advisor, would they be doing any financial planning? It would all be just managing your portfolio. You're up this much. I think we should buy this and sell that. And if you want to give me more money, I can buy you more stuff. That's what it was. But now I think the profession is realizing the value. What makes clients stick to us is the planning, and we're seeing more of it. And I think clients, the more they demand it, the more they'll get, and the better, more happier they'll be.
Well, it's music to my ears. When I started in the business 30 years ago, every client had a plan, like it just right from the beginning. Everyone wants to know if they're going to be okay. They want to know when they can retire, how much they can spend in retirement, how much do they need to save between now and retirement. In addition to all the other goals that they want to accomplish in their lifetime, can I send Johnny to university? Can I buy that vacation cottage or that recreation property? Can I travel the world? Like, can I live my best life, and what does that look like? And the planning is the core component to all of that. And I think today people are starting to realize that the money management, it's important too. You want a good diversified portfolio that is going to give you the best risk-adjusted return for your situation. But I think the money management is becoming more commoditized today.
Without doubt, it is. I mean, let's be honest. You could buy a asset allocation ETF. That's an exchange traded fund that holds a mix of stocks and bonds. And there's different versions for aggressive investors and more conservative investors. And they have light, slow fees. You could keep shoveling money into that for 30 years, and you will do just fine. They are nicely diversified, cost contained, the automatic rebalancing. There's a lot of digital investing apps where you could buy these things for free. That's basic money management, soundly done by reputable global firms at a low cost. Anybody can do it. Now, will they do it? That's where it comes down to the real question of support and all that stuff. But that's not enough just to be putting money into good investments. As we've just been discussing, you need more. And the further you get down the path, the more you realize you need more.
Rob, this is super helpful for our audience. Any other financial tips that you've got for people that you want to share today?
Well, we were talking about the housing market a little earlier, and I want to strongly encourage people not to buy too much house. Don't extend the affordability measures right to the very limit. Like if someone says you could afford a house that costs 1 million, maybe consider 900,000 if it's at all possible, or less. Because people push affordability to the max because they had this feeling like my house is going to be appreciating in value, and it's a good deal. I'll be under a financial strain by building home equity all the time. That's not happening anymore in a lot of cases. And I think people are kind of regretful, and they're feeling a little bit of remorse about their purchase and all that sort of thing. And I think if they were paying a little bit less, if the mortgage payments were a little lighter and it left them a little extra room, they would be more willing to just ride through this period of adversity. And I do think it's just a period of adversity. Real estate will be a strong asset for many years to come, but it will have to work through this little period. And those who are not tied down with giant mortgages are much more nimble and much more able to enjoy the day-to-days of life because they have more money for other things, including saving and investing.
Yeah, so leave a buffer. Don't max yourself out, and be in it for the long game. I mean, if you were renting, you'd be paying that money every month regardless. So if you've left a buffer, maybe hopefully your monthly expenses are a little bit closer to what the rental value would be every month, and you'll be fine. Just ride it through. Any other tips?
No, I think we've had a great chat.
Great. Well, I know that you recently wrote an article, 8 Doable Steps to Protect Your Finances in 2026. That sounds interesting. We didn't have time to go through it today, but where can people go to keep in touch with Rob Carrick?
Well, for many years, I worked on a newsletter when I was a Globe and Mail employee, and now I've created my own personal finance newsletter. It's Rob Carrick Substack. It's on the Substack platform. There's tons of great writers on there. I'm a personal finance guy. Added my voice to the mix. Just Google Rob Carrick and Substack. You'll see it. You can sign up. A lot of the content's free. Some is for subscribers, but I'm happy to connect with people that way. It seems to really be catching on.
Rob, thank you. Keep doing what you're doing because you're sharing such great information, helping Canadians stay informed so they can make smart decisions and build wealth. Really appreciate having you here today.
Great chat, Sybil. Thanks for having me.
And thanks to our audience. We really appreciate you, your follows, your views, your comments, your shares. What do you want us to talk about next? Let us know at thewealthylife.com. As always, please seek independent professional advice before taking action. We are here to provide information to help you learn and ask the right questions to make smart decisions so you can live the wealthy life.